All right, so welcome to another video. Today I'm going to share with you a handful, probably 2 to 3 option trading ideas when it comes to Shopify if you're trying to kind of buy on the dip. Again, it's not a recommendation to buy, sell, or trade anything. It's just my own personal opinion and insight. And if you want to grab my opinion, feel free to join the Discord channel. The link is going to be in the description below. Share with you some charts and other great things regarding trading. All right, so you can also check out some of the courses that we have coming up. We have a risk array class coming up very soon as well, so don't forget that. All right, let's take a look at Shopify here. So this stock's been tanking for a little while. If we kind of look at the monthly, you can see we're pulling back in a big way. So when you're putting on this trade, you have to, number one, understand you're stepping up into a freight train or stepping right in front of that. And if you're stepping up in front of a freight train, you got to have enough room when you're dealing with options, right? Because it's pulling back pretty heavy. So that means a longer time frames. Right now, if I look at the technicals, we're basically pulling back and we're breaking this. So I don't know if this will come back, fairly far, or if it's just going to start bouncing very quickly. So there's a couple of different things you can do. The first question is are you long or short? Typically, I'm going to approach it from the long side because most people are going to be, long or bullish. They're investing on the bullish side. So I approach it from that end because the average investor is looking for stocks to go up. So if we're pulling back and you're trying to catch a falling knife, there's only a handful of ways to kind of do it. And you want to be a little more careful. So I'm going to show you one way to do it is, okay, so you have these option dates, between 15, 43, 56, 92. The problem you'll get into is you'll have earnings eventually. So you want to be a little bit more mindful. But if you're looking for this in the long run, so, okay, what you might end up happening is like you lose, and then eventually you get to the wins. So if you stick to the same vehicle, you have a few losers at the beginning, but we want to minimize these losses. So what we're trying to do is wait till we get the winner, and then we can go a little bigger or heavy. But if you want some exposure, then you can start putting on nibbling some positions, because that's where you get kind of that nibbling opportunity. Okay. So if I'm looking to nibble, I probably don't want to do anything like, 15 days, 22 days, because it's a freight train going down, right? The market's choppy. I want to go a little longer duration, maybe 36, 43 days, maybe 56 days even. So I'm going to show you maybe around, let's just say about 56 days. I'm only going further out because it's a huge, massive freight train, right? And you want to be a little bit more careful. Okay, so what I'm going to do is just talk about just basic selling vertical premium, let's say 620. And let's go 615. Okay, so that'll give me about, that 25 delta right here. Okay, so now here's a bit of the problem with this. Okay, when you look at this, what you're really doing is you're stacking about 1 delta, which is not that much, right? And unfortunately, if you're trading lighter contracts on a stock like this, there's not a ton what you can do. So if you go with like a back ratio spread and I go in and like I buy an extra one, all of a sudden it warps my picture. So there's not a ton that I can do right here. So if I'm trying to sell premium, I don't have room or wiggle room to kind of make it work, right? So if I'm bullish and I want to be a long investor, what I'll probably do is, look, I've got the 20 delta over here. So it gives me about a share. And then the big stock like this, that might be a lot for you guys because everybody's got different sizing accounts. Let's say if we're doing 10 contracts, you got about 10 shares. Okay, so that's a 10 delta. Now what we're doing is we're going to go to the trade tab again, and I'm going to go ahead and show you the vertical on the other end. So now I'm going to go in and let's say 200 strikes. We'll go in and we'll go to the downside, go down, go down, go down. So now I'm looking at a delta of maybe about 10. And the reason I'm going so far out is because I want to be a little more bullish, right? If I'm a long-term investor, I want to be bullish. But by just going in and doing kind of 10 contracts of the regular put verticals, that's a $3,400 trade. If you're doing one contract, you're putting on $350. So for you, $350 might be is where you're at. Other people are trading larger. So let's start with the $350. How can I reduce that size? Well, what I could do is I can go in and put that other end, and now I'm a little bullish, and now I cut my deltas in half. So it went from like 0.9, almost 1, to about half a delta. It's harder to see on a big stock like this. That's why I went with 10 contracts. So now you got 10 deltas, and then if I go with 10 over here, I'm cutting it to 5. Now the strike difference here, you can see is $9.90, $9.95. I'm making 40 cents on one end, and I'm making $1.60 on the other end, multiplied times 10 contracts, right? So this gives me a lot of room and range now for that stock to head higher. So I have this bubble as well. So even if it goes up another 100 points, that's pretty good. And I should be in the sweet spot. And we're only looking for a whole expected move of about 150 points in that time frame. So if I'm looking for about 150 points, there's 100, there's a 150. So that might actually only get here. But if the stock's oversold, yeah, of course it can go a little faster. So I could get into a little bit of trouble on the upper end, but that's why I gave it more room. If you're a little more concerned about it, just bring in the right side tighter. So it's kind of like saying, hey, I'm going to do a long investment on Shopify, but I'm going to do the long investment more with an iron condor rather than doing a long investment with just buying verticals or selling vertical premiums. What you can do is just bring these in as much as you feel comfortable with to tighten up that risk. So this way this delta keeps getting reduced, and now you're getting in maybe only 3 shares instead of like 5 or instead of 9. So you could do basically this iron condor. You could also put it in all as one trade and then kind of let it sit. So if I was to do it all in one trade, we've got 620s and 920s. So let's do it that way. Okay, so actually I'm already here at 920s. So let's start here. Let's do even 910s. Right here, I'll put this here, and then the 620s, I'll go over here. I could even do 625s. Okay, and there we go. And now I've got kind of that similar spread right there. Okay, set up, and I can do 10 contracts. And there we go. So now I'm bullish with about 3 shares in theory. Really, it's a 3 delta. 16 theta, meaning you make $16 a day, and 32 negative vega. So that'll help me on the upside as well as the stock continues to push higher. So what this does is really reduce my left side problem or risk. I'm only risking 2,800 instead of maybe 3,500. So it reduces that risk quite a bit. The downside is a little bit short vega, and but if you're bullish on something, you're gonna need some positivity, and that positive upside will be that vega. Even though the delta is small, you got a pretty large vega to help you out over there. And within a little bit of time, what's gonna happen is maybe as this heads higher, you might be around the $309 out of $3,000. So you're looking maybe about, 10% there, and you take the trade off. So that's kind of what you're looking for, is you're trying to hold that trade for a bit. Okay, another idea for you. So this is going to be idea number 2 for a trade concept, is to do a diagonal. And where a diagonal might be beneficial, and again, I'll do 43 days now with a diagonal, is if you're kind of bullish on a diagonal or bullish on a stock and you want to go into it, doing a diagonal is nice, because when you do a diagonal, what's happening with a diagonal is that it has positive vega. And with positive vega, it helps you on the way down a bit, because those option premiums don't get hit as much. The downside, again, there's always a trade-off. The downside is on the upside, you probably won't make as much money, because what's happening then is you lose on the vega side. Okay, so similar how the other one benefited us. So what's great about diagonals here is I could do this rotation, and I could actually construct it with only about a 1.98 delta, which is a lot smaller than that iron condor. But if you're more comfortable with selling like verticals, iron condors, you could do that. This diagonal, what I could do is kind of slowly start rotating it, like let's say a little more. Now I got 3 deltas, and I could actually craft it that way. And I actually need less kind of contracts to play with it, rather than the other one I need like 40 contracts. This one I kind of only need 1. So it just depends for you how you like to trade. But I could also just do like a 5 wide spread here and just do kind of 2 contracts, and now I've got kind of the 3 delta. But what you'll notice here in this diagonal is that, basically it's really similar. Like if you look at the curve on this one, let's go single. Like look at this curve right here. This curve is kind of similar to the curve here on the iron condor. Not exactly, obviously, but the curve is giving you that upside move. The big difference here is the positive vega. And when you're looking at this, and you can see you got a nice big positive vega. So this way, when this one sells off, it actually helps you a little bit. You won't lose as much, whereas the iron condor, you'll lose much more on the downside. But here, you won't make as much on the upside. So if you're even more cautious, you could do a little bit of a diagonal like this with light rotation. If you're more aggressive, you could spread the difference or distance between the strikes. and kind of go, rotate it more. And if you're even more aggressive, you could just kind of, go a little more even out of the money. So you could even do something like this where you're getting back to that 9 delta. But again, that's just a personal preference of how aggressive you want to be in it. My goal here was to show you a couple of different idea variations on if you wanted to go long the options or the stock. Then this is kind of the way to do it when you're dealing with options. This is 2 ways and 2 approaches. If you're really, really cautious, you could even just go, let's say, out of the money, but you're doing not a diagonal, you're actually doing a calendar. So you're just putting it like kind of a calendar where you got positive vega, some upside room. The problem with this sometimes is if it overshoots and it does bounce about 100 points, 75, you could start getting into trouble. So with these, usually you might want to make them a little extra bullish than you think, because that vega will hurt you on the upside. But if they sell off, they're not going to hurt you as bad or as nasty. So it's a little bit of a trade-off, but it's like for a super cautious person, like initially just getting into like the first position of maybe Shopify, and then later you'd build to it. So it's kind of like, hey, I want to be invested, but I'm just really cautious on it. I want that extra vega. So anyway, so those are a couple of trades that you could look at. And looking at Shopify right here, one right at the money, just light rotation, gives you a little bullish feel. You could go, 2 of them because you got that vega problem, because if it overshoots and bounces like in a day, these are the ones that could get you in trouble. Whereas the iron condor, if it bounces, that short vega will be fine, but you'll get less protection on the downside. So it's basically setting up a non-directional trade for a direction, making them a little more bullish as a long investment. And using them a little bit to make sure you're using less capital than you normally would. It's less aggressive, shall we say. All right. Anyway, I hope that helps. Thank you so much for joining me. Hope you check out some of the other classes we have available coming up, because we do have a class for risk arrays coming up here next week. And thank you so much, and hope you got a lot out of it. I'll see you next time.